Hello, I'm Michael Hainsworth.
And I'm Jeremy Kronick, Director of Monetary and Financial Services Research here at the Howe Institute.
And I'm Steve Ambler, fellow in residence at the Howe Institute.
Jeremy and Stephen's latest report for the Institute is titled, Quo Vadis? The Future of the Bank of Canada's Balance Sheet. So where is the BOC going? The report explores the consequences of an enlarged balance sheet and the structural changes that may continue to expand it. All of this amid a soaring inflationary environment and that 1-2 punch of the Bank of Canada's tightening cycle and quantitative tightening aimed at knocking it to the mat. Gentlemen, thank you very much for joining us today.
Thanks for having us.
To be here.
Bring us up to speed. Jeremy, where are we today compared to pre-pandemic? And Steve, perhaps you can follow up with the why.
Sure. So before the pandemic, the bank's balance sheet was around $120 billion. It shot up to, I believe, around $575 billion during the middle of 2021. It's now come back down as the bank has started this tightening cycle and is around $435 billion today. So down from its peak, but orders of magnitude bigger than it was when we started.
So, Steve, how did we get here?
So Jeremy talked about the increase in the overall size of the balance sheet, but if you look at settlement balances, which are essentially deposits that banks and other financial institutions hold with the Bank of Canada, the increase is even more staggering than that. Before the pandemic, we were talking about less than $1 billion, something in the order of $250 million. And those settlement balances peaked at, I think, $250 billion, if my memory is correct. So we're talking about an increase on the order of 1,000 of those. So what happened was, and there were basically enough settlement balances around so that banks had enough balances so that they could operate in the payment system, clearing payments at the end of the day. Some of them had excess balances to lend to other banks in the overnight market. There was an active overnight market. When the pandemic hit, the Bank of Canada, first of all, started to try and stabilize financial markets by buying large amounts of securities, not just federal government debt, but public debt from provinces as well, and private securities to keep financial markets liquid and keep down spreads between various different types of instruments. They got rid of a lot of the provincial and private debt fairly quickly, but the amount of federal government debt that they bought, they've kept a lot of it, and that's what's mostly responsible for the huge increase in settlement balances. What that does is that essentially all of the banks that hold balances with the Bank of Canada are extremely liquid. The overnight market essentially has disappeared. They don't need to. There are no banks that need to borrow balances from other banks anymore. And in order to incentivize the banks to hold all these settlement balances, the Bank of Canada, early in the pandemic, in March 2020, essentially started paying the same rate of interest on those settlement balances as the overnight rate. That's when the overnight rate went to what the bank considers it to be its floor of 25 basis points.
So, Jeremy, help me, who's certainly not a Bank of Canada expert, understand the implications for this. Why are you raising this is it a red flag? Is it a yellow flag? Why write this report in the first place to draw attention to this issue?
Well, so I think there's a few different things at play. So one, this is a complex topic, the bank's balance sheet. And obviously the bank's been in the news a fair amount with inflation, as high as it is, and a lot of discussion around quantitative easing, which is what Steve was just talking about, what the bank did once it hit the effective lower bound for its overnight rate. So we thought, first, it was important just to, get an explanatory piece out there on what's happened to the bank's balance sheet and why it matters, what role it plays, in its impact on inflation. And then we also wanted to turn to what are going to be some of the driving factors for the size of the balance sheet as we look ahead in the short run, in the medium run. In the short run, we know they're unwinding some of this, some of this increase in the balance sheet as part of its tightening cycle. But there's going to be some forces that are going to be, driving the balance sheet, we think, to stay somewhat elevated in the medium run. And, we wanted to get out and explain what those forces were, and again, what impact they could have, on the operation of monetary policy and the hitting of the inflation target.
Well, then I suppose, Steve, we should get into the importance of shrinking that balance sheet as a means of ensuring that the Bank of Canada has more ammunition to fight whatever may come down the pike in the future.
That's right. I mean, some people would actually say that this actually does, in a sense, provide additional ammunition to the Bank of Canada. I mean, we're now operating in what's called a floor system, where settlement balances or reserves are plentiful, and essentially the overnight market has disappeared. What that allows the Bank of Canada to do is actually set an overnight rate target and an overnight rate that's independent from the amount of settlement balances in the system, which are overly plentiful, is one way of putting it. It's a very different operating framework now than what we've seen before in Canada. In the U.S., the Fed has operated under this type of system ever since the end of the financial crisis. So they've had quite a bit more experience operating with a system like this than we do. But for Canadians, I think it's something that's new and quite a bit different. So we thought we had to explain some of the numbers and the justifications as well.
So do I understand this correctly? From what I've read of your report, we're in a situation where at the end of the day, often in the past anyway, banks would need to borrow either from the Bank of Canada or from each other to ensure that there's an effective settlement at the end of the day so that the books are balanced, basically. But because of the environment in which we find ourselves right now, banks aren't needing to turn to the central bank to make that happen. They're just working between each other.
Well, so it's a little bit different. So the overnight rate is the rate that the banks lend and borrow from each other to settle, as you said. And so in normal times, before the pandemic here in Canada, the bank operated what's called a corridor system. And the idea there is that the rate they can earn on deposit at the bank and the rate they can borrow from the bank, the overnight rate sits in the middle. So you're trying to incentivize the banks to borrow and lend with each other to settle, right? But in this system now, under the floor system, whereby there are, as Steve said, overly plentiful settlement balances for each bank, they won't even need to borrow with each other, lend with each other to settle at the end of the day because they have sufficient settlement balances on their books. So that's where you get into this floor system as opposed to a corridor system. And because of that, you have to set the overnight rate and the deposit rate equal to each other.
Yeah, under the old system, there were some banks that had surplus balances and other banks that needed to borrow, and the Bank of Canada could just inject a small amount of settlement balances into the system, so that's essentially what determined the overnight rate. It had a target, and then by varying the amount of settlement balances, it could hit the target by supplying extra reserves or balances into the overnight market. Now, as Jeremy and I have said, settlement balances are so plentiful that there's no more overnight market. And the overnight rate is essentially equivalent to the deposit rate which banks receive for leaving balances with the Bank of Canada.
So what are the implications for the Bank of Canada when we talk about its balance sheet being 3 times greater than what it was pre-pandemic?
Right. So this is where it gets, a bit tricky, right? So from a monetary policy perspective, as Steve mentioned earlier, it does give the bank 2 different tools to perform monetary policy with, right? Because now the overnight rate and the Bank of Canada's balance sheet are independent of each other. So, and so they can use both to do the kind of monetary policy they feel is necessary to hit the inflation target. I think where the debate lies, or where the question lies, is how much of the quantitative easing that got us to this point, led to the inflation that we're seeing today. And this is a really Interesting topic that I think there's going to be a lot of research on for the coming years, because if you look at what happened to the U.S. and the Fed, who did quantitative easing back in 2008, there was no inflation really. I mean, the battle after 2008-09 was to get inflation up, right? And despite the fact that they did this quantitative easing. And then this time around, the quantitative easing that a lot of these countries did has led to inflation. So the question is, how much is QE responsible for that? And then what differences happen today compared to what happened 15 years ago? But in terms of just purely the operational side of things, this does give the bank two tools to perform its monetary policy.
So if quantitative easing plays a role in increasing inflation, and now we are in a high inflationary environment, what is the connection between shrinking the bank's balance sheet and the implications for inflation? Steve?
Well, the banks own, initially, as I said earlier, the initial buying of all of these assets was mostly to stabilize financial markets. And it was later on that once things had sort of calmed down, that the Bank of Canada turned to quantitative easing per se. And their main justification for buying more assets was to actually keep longer term interest rates low to aid in the recovery. So it wasn't, so the link with inflation is not direct. And as Jeremy pointed out, in the US, the Fed did an enormous amount of quantitative easing, and inflation stayed low. It stayed under target until the pandemic hit. And there is already a large literature on quantitative easing in the US. And some researchers actually claim or maintain that by paying what the Fed did and what the Bank of Canada is now doing, paying interest rates on reserves or on settlement balances, you're actually incentivizing banks just to sit on these balances, keep them with the central bank, rather than lend them out. So I think the big and perhaps the crucial difference between what's going on now, both in the US and in Canada, and what went on between, say, 2011 and 2020 is what happened with government deficits.
So, Steve, while the BOC is shrinking its balance sheet, you write that there are forces that might keep it elevated for a while yet.
Yeah, so simultaneously with quantitative easing and the pandemic and everything else, there's been some major changes in the way the payments system is operating in Canada. So essentially, they're going from settling everything between or among banks at the end of the day to a real-time payment system. So things are going to be settled actually during the day rather than just at the end of the day. And we think, this is probably something that's going to elicit some discussion as well, that this is actually going to be lead to banks demanding more settlement balances because they have to have them ready pretty much any time during the day to swap payments across banks. Whereas before, they could just leave things sitting until the end of the day, and then if they needed extra balances, go into the overnight market and borrow them. So we think that this is going to lead to an increase in demand for settlement balances. So the settlement balances are still going to be in excess supply. So we're still going to be in a situation where the overnight rate and the deposit rate are going to be equal, and there's going to be more than plentiful balances in the system. But as the supply of balances shrinks, that's quantitative tightening by the Bank of Canada, simultaneously we're going to see a gradual rise in the demand. And that means that sooner or later, we don't have a firm idea on how long it's going to take. We're going to get back to a system where settlement balances are no longer going to be clearly in excess supply. So that would mean a return to the corridor system that we had before the pandemic.
And that's not even taking into account the prospect of digital currencies, a central bank-based digital currency at some point in the future.
Yeah, that's right. So that's another part of it as well, would be the introduction of a central bank digital currency. And to Steve's earlier comment about, also potentially eliciting some discussion is around what kind of increased demand there might be for a CBDC relative to our demand for cash today. Right. Our argument that we're putting forth in the paper is that, part of why people don't carry cash today is because it's there's an opportunity cost of their time to going to the bank, going to the ATM and taking out the cash. Under a CBDC with digital cash, that's not really an issue anymore. And so things like that might increase the demand for public money, which is what cash is, which is what CBDC is. That would also have the effect of potentially increasing the size of the balance sheet. Now, even here, there's further complexity because to the extent that the demand for public money comes at the expense of deposits being held at commercial banks, there are some issues around what those commercial bank balance sheets might look like for liquidity purposes, for capital purposes, which could change the settlement balance story. So there's a bunch of different factors at play that need to be worked out. But we think that increased demand for public money could have the impact of also keeping the balance sheet more elevated than it was before the pandemic.
So then what's the impact on monetary policy when you've got this tug of war between the BOC and these external forces?
Yeah, so I can jump in there, and Steve, maybe you'll have some thoughts as well. So, I mean, again, if we go back to the original story about the floor system, if the point we're making is the balance sheet's going to remain elevated in the medium run, which might force a floor system in place, there are upsides and there are downsides to such a system. As we mentioned earlier, the real-time settlement is touted as one of the good things about the modernization of our payment system, and the floor system helps with that because of the abundance of settlement balances. But there is also, there are also potential downsides. So one potential downside of the floor system is the bank has to have an elevated balance sheet, has to hold more Government of Canada debt as a result. So they're playing a bigger role in that market. To the extent that has an influence on the interest rates for that Government of Canada debt, well, that may not be desirable, right? So there are these upsides and these downsides. I don't think there's a major disadvantage of the floor system, but there are these, like I said, upsides and downsides that we just need to sort of understand and make sure we're aware of.
That's right. I mean, we still haven't, the Bank of Canada still hasn't settled on the exact form that CBDCs are going to take. I mean, one of the possibilities is actually opening up deposits at the retail level at the Bank of Canada. That would likely, in fact, shift the demand for deposits from the banking system to the Bank of Canada. And, potentially, the question of whether the Bank of Canada could do this more efficiently than chartered banks could, I think that's a big question. But if enough deposits shifted to the Bank of Canada, as Jeremy said, that if the Bank of Canada still limits itself primarily or exclusively to holding federal government debt, it's going to be playing a bigger and bigger role in that market, influencing the interest rates in that market, and that has spillover effects onto interest rates in other, all sorts of across the spectrum as well. The other big question is if the balance sheet were to expand enough because of, opening up retail deposits, that's a liability for the Bank of Canada. So the bank would at least have to play a bigger role, hold a larger fraction of federal government debt outstanding, and the temptation or the possibility of the danger, I think it's a danger, would be there that it expands into holding other types of assets. That has happened in the U.S. I mean, the Fed actually holds a wide range of assets, including mortgage derivative securities right now. And that's basically what that means, is that the central bank then actually enters as a player in credit markets and how credit gets allocated. And I certainly think that this is something that the central bank should steer clear of. It should stick to monetary policy with its main goal of keeping inflation under control and not get into the credit allocation business.
Can I jump in there, Michael? So I fully agree with Steve's point about the bank staying out of the credit allocation business. I do want to clarify a couple of things on the CBDC front. We haven't even settled on the need for a CBDC, let alone kind of the design. And I, from my conversations and, from my understanding, I don't think that they're envisioning the version where everybody has a deposit account at the Bank of Canada. I think that the desire is to be as least disruptive as possible to, the financial sector, which I think is the right move. I mean, there's a token-based version of the CBDC where we don't need to have retail accounts, much like we do today, right? We don't have, we can hold public money in the form of cash without, having to have an account at the Bank of Canada. I think that's the desirable system. But to Steve's point, I mean, there's going to be a range here where the size, of the Bank of Canada's balance sheet goes up based on whether they do the CBDC and then therefore the design of that CBDC and the decisions that we make on how much public money versus private money to hold and what that then means for commercial banks and their balance sheets. I think there's still a wide range of, impact size with respect to CBDC should that decision to do a CBDC go ahead.
So let's come full circle here as we wrap up our time together. The Bank of Canada is raising interest rates at an unprecedented clip. It's a bit of a double-edged sword for the BOC itself, isn't it?
Yeah, well, I mean, so I think what you're trying to get at there is this sort of story about operational income versus loss. Right. Because what happens is, the bank when the bank bought all these bonds during the pandemic and as we exited out of it as part of QE, they paid the bonds are at fixed rates, whereas the settlement balances are based on the deposit rate and the overnight rate, as it turns out under the floor system. So as that overnight rate's gone up, the deposit rate's gone up with it, and the interest expense has gone up, but the interest revenue has remained relatively the same. Obviously, it changes based on the bonds that they sell and the maturity of those bonds, but it stays relatively the same compared to the interest expense on those settlement balances. So for the first time really in the bank's history, they're likely headed towards an operational loss, right? From the perspective of interest expenses exceeding interest income. What happens there is complicated, right? There's a complexity to it because we haven't been through it. So the way that we read the act is the bank will first draw down on its reserve fund, but that reserve fund is pretty small relative to the holdings we're talking about here. So that reserve fund can go negative, in which case when the bank becomes profitable again, it would replenish part. So the profit it would earn once it's back in a profitable position, part of that would go to replenish that fund. Part of it would go to the government of Canada. What the Fed does, which we think is actually a better system, is it has what's called a deferred asset. And so it has to replenish that whole deferred asset before anything can be remitted back to the government. But to do that would require, we think, at least according to our understanding of the act, a change to the act itself. So there's a lot of complexity around this, but that's sort of from an operational perspective, how it would work. Steve, I don't know if you want to touch on the indemnity agreement in your, I'm sure you have some stuff to say as well.
Jeremy talked about what's happening in terms of operating revenue and expenses. Another extremely complex question is that especially longer term bonds that the Bank of Canada is holding are subject, as interest rates rise, are subject to an unrealized capital loss. And so there's a question of how to deal with that just from a pure accounting perspective. If you actually put that on the books the value of the bank's assets are decreasing as interest rates increase, and that means that the value of the bank's equity position is decreasing as well. So that has a similar effect to what happens with operating if the bank is running an operating loss and running down its reserve. So this and once the indemnity agreement is there, that the government is supposed to compensate the Bank of Canada for capital losses that it suffers due to rising interest rates. But once again, the details of this are extremely complex. We've had discussions with people at the Bank of Canada, and it's not 100% crystal clear how this is all going to come out in the wash. We think the Bank of Canada, at least in its recent announcements, it sort of said, well, we're continuing our quantitative tightening program. So essentially what that means is they're letting assets run off their balance sheet as they mature. We think the bank needs to do a bit more explaining about how all these things are operating in a way that the general public can understand. So if we're having such a hard time understanding what's going on, I think the general public is going to have a hard time understanding what's going on as well.
Okay, so then since we've only barely scratched the surface of an incredibly detailed report, final question to each of you. If there is one takeaway for the listener, what would it be in your mind? Steve, age before beauty.
We've gone from this corridor system to a floor system. The bank has said, well, we're just going to keep on sort of carrying on, letting stuff run off the balance sheet gradually in a very passive kind of a way. I think it's incumbent upon the bank to say, are we with the floor system forever? Are we going to go back to a corridor system? If so, how are we going to get there? Explain and, do some planning on what's going to happen over the next 4 or 5 years with its balance sheet, what that implies for a floor system versus a corridor system, and think about how to communicate all this to the public.
Jeremy?
Yeah, I think that's a really interesting way of putting it. So, inflation is at a 40-year high, and I think the banks, obviously, their credibility has taken a bit of a hit. And there's fears, and I think rightful fears, about politics getting, in the way of the independence of the central bank. And so, one of the most important things you can do to alleviate those concerns, well, first is get inflation back down, and I think they're doing that, largely through interest rate hikes, which is, I think, largely what they have to do to get inflation back down. I'm not sure how much quantitative tightening, so shrinking the balance sheet faster, would really have much of an impact. So I think they're taking care of that. But then to Steve's point, on the independence, communication and explaining things is, I think, critical to making that work. And so there are, the future of the balance sheet might look a lot different than it did pre-pandemic. And I think it's important then to make clear that this doesn't change the ability central bank to hit the inflation target. And that's the point. We explain why we think the balance sheet is going to stay elevated, or at least elevated relative to it was. But at the end of the day, we don't see a major, impact on the bank's ability to hit the target, whether it's a floor system or a corridor system. But, so I think communicating along those lines, and that they're going to remain focused on staying out of markets other than the Government of Canada debt market, which they've always played in, I think will be critical here.
Jeremy Kronick is the Director of Monetary and Fiscal Services Research at the C.D. Howe Institute. Steve Ambler is a Fellow in Residence. Visit cdhowe.org for their report co-authored with Fellow in Residence Torsten Koppel titled Covatus, The Future of the Bank of Canada's Balance Sheet. Still to come from the CD Howe, the 2022 Scholars Webinar Series. On November 10th, the Institute welcomes Joseph Stiglitz, the professor of the School of International and Public Affairs at Columbia University, and the recipient of the Nobel Memorial Prize in Economic Sciences and the John Bates Clark Medal. And November 15th, Leveraging Real-Time Data for Real Health Benefits, a webinar with Janet Davidson, a fellow in residence at the Institute and chair of the board of the Digital Research Alliance of Canada, along with Kimberlyn McGrail, professor at the UBC School of Population and Public Health, alongside David O'Toole. He is the president and CEO of the Canadian Institute for Health Information. If you're watching us on YouTube, please be sure to subscribe and click that bell icon, of course, to get the latest episode of the podcast. I'm Michael Hainsworth. Thanks for joining us.
You've been listening to the C.D. Howe Institute podcast with Michael Hainsworth. Subscribe on iTunes, Google Play, and Spotify. The C.D. Howe Institute is an independent, not-for-profit research institute whose mission is to raise living standards by fostering economically sound public policies. The Institute is widely considered to be Canada's most influential think tank and a trusted source of essential policy intelligence, distinguished by nonpartisan, evidence-based research and subject to definitive expert review. Visit cdhow.org and follow us on Twitter and LinkedIn. Thank you.